Welcome to Money Control and wish you a very happy Diwali. Last year was a fantastic year for the markets. We had the Nifty touch record highs. Foreign institutional investors were largely sellers in the market, while domestic investors, both coming directly into the market as well as through the mutual fund SIP route, kept the markets quite resilient throughout the year. What does Samvat 2081 hold? Over the past few days, we spoke to a number of experts and we get you pretty much all the answers, well, most of them over the course of the next 40 minutes. And then, of course, our in-house markets team will bring you some fireworks in the Paka stock section. I'm Mahalakshmi and this special Muhurat trading session is co-presented by Motilal Oswal. So first things first. The biggest driver of markets last year was the continuous buying by local investors. So every worry was shunned because there were buyers emerging at every slide. Can domestic liquidity continue to support our markets? We know that this time it is different, are four most dangerous words in markets. But is this time truly different? Listen in to Manish Chokani.
It's always tough to say this time is different. But it did feel like this time is different.
Right.
And something we waited for decades, that the Indian investor would be a counterforce to the foreigners who would run the market at their whims and seas. And the power of retail, first time we've truly experienced it. I'm just so happy that of the 5.5 trillion market cap, 85% sits with Indians. That wealth creation which has happened here is unprecedented, and that gives you a stock of growth ahead for the economy. The reality is we've had an asset allocation shift going on in India. For years, I've been arguing that we have, say, a 25-30% saving rate. So on our current, say, $4 trillion, we save at least $1 trillion a year. Half of it is still going into hard assets like real estate and gold.
Right.
We are still putting maybe $75 to $100 billion in gold every year. The stock markets are getting $50 billion
right.
through this whole SIP scheme and whatever. So it's not that all the money of the world has come to the stock market.
Right.
It is a shift which is occurring. And like I said in the beginning, a lot of wealth in the past used to be in real estate, which people are realizing we can unlock and create capital from it to use to grow.
Right.
A lot of money historically has been indeed in gold, which because of the way the rupee has depreciated, in fact, gold has given the same returns as the index over the last 20 years. So all the hard work, most people do, it was better off you just bought gold or you bought an ETF and sat down. A third part of it is the banking deposits. I don't think, if I'm not mistaken, is in excess of few $1 trillion. So to get to this $4 trillion wealth creation in the stock market is something which is unparalleled, and it's not a trend which will reverse easily. Even if you now have a 2008 type event, it will be a setback. But if we can keep compounding in India at this 13% type earning growth rate with this 11% type nominal GDP growth rate, remember that 90% of our market cap lies ahead of us in the next 20 years. And the average investor, like I said, is now 32 years old. So we will inevitably have setbacks. We will inevitably have time corrections.
One of the key pillars of growth for stock markets thus far has been our strong economic growth. But this year, it seems like we are going to face some economic headwinds. What's coming and how long will this slowdown last? Prashant Jain weighs in.
So yes, I think there are signs of a slowdown in consumer category. And I think this I have written even earlier in the past. See, whenever consumption is supported by rising leverage, it means you are preponing consumption or consumption is growing ahead of income levels. And at some point of time, it will lead to moderation in demand. I think that is what we are undergoing right now. And the central bank also has been trying to slow down the growth in retail loans, especially the unsecured retail loans. So I think it is not worrisome. It is a statement of fact that this is what we are passing through. I think as far as exports is concerned, I think there is some slowdown in the world economy. And I think the Chinese surplus capacities are there for all to see. So it is not going to be easy for India in the near term to ramp up manufactured exports. Service exports continue to do extremely well because there our comparative positioning is very strong. So this could lead to some moderation in these pockets of the economy, but otherwise I think there is no reason to be pessimistic on the economy at all. In fact, we think over time the economy should grow somewhat faster compared to the past.
A slowdown in economic growth definitely means a slowdown in corporate earnings. Last year, we saw Nifty earnings grow quite smartly, but this year, consensus estimate for Nifty is significantly lower at around 5%. This quarter, by the way, is a washout. Best case scenario, Nifty earnings growth is likely to be 2%, the lowest in 17 quarters. So what to expect with respect to earnings for FY25? Saurabh Mukherjee is not too optimistic, but Madhusudan Kela is not too pessimistic.
So I think it's worth understanding in a way how the economic cycle plays down, because that will give us a sense of the drivers of the economic slowdown, which in turn will give us a sense of how long it lasts. If you think about it, right, the Russian invasion of Ukraine in 2022 led the Federal Reserve to hike by 500 bips. The RBI hiked by half as much. Now, whenever a central bank hikes rates by 200, 250 bips, with a year's lag, with an 18-year to 18-month lag, the economy slows down. And sure enough, the hikes of 2022 and 23 are biting in 24. We can see very clearly consumption growth has slowed down pretty much across the board, not just a big ticket, even small ticket consumption growth has slowed down. The second piece was the government stimulus. Quite rightly, the government of India exerted a massive stimulus during COVID. It was less punchy than the stimulus that the Western governments gave, but even in the context of India, the budget deficit was correctly and appropriately allowed to rip during COVID. As Nirmala Sitharaman has consolidated the budget deficit, reduced the budget deficit over the last 3 years or so, the fiscal policy also has turned contractionary. So you have monetary policy which has turned contractionary, fiscal policy that has turned contractionary. The global economy also has slowed down, and naturally, therefore, the Indian economy is slowing down, very clearly showing up in corporate earnings, both for the June quarter and for the September quarter. The September quarter, Mahalakshmi, I suspect at the market level, we'll end up with close to zero earnings growth. And my reading is until monetary policy turns expansionary again. So if the RBI starts cutting in, say, December this year, I think we're looking at the middle of next year, perhaps the end of next year, for the economy to turn the corner. I don't think the government is suddenly going to become fiscally expansionary. But if the RBI starts cutting from December this year, I think towards Diwali 2025, we could again hope to see corporate earnings growth picking up again.
All of these assessments we made, first of all, it is based in 1 or 2 quarters only. So I think it's too early to conclude either way things. We have to also look at things that, there was a election, there was a state elections, and decisions get slowed at this point of time. Specifically, the government is spending, which has been slow. So I would not conclude that there is some massive slowdown which has happened. Let us watch the second half, and based on the numbers which comes, we will make up our view. But I would not conclude either way that, and this is just, 1 quarter of bad things or 2 months of bad numbers from few companies is concerning in the short term, but nothing changes in the long run.
For the past 2 years, investors have been gingerly about valuation of Indian equities. A recent Moneycontrol poll, in fact, suggested that it is not geopolitics or Fed rate. What investors think of as top risk to stock prices is domestic growth and valuations. Just how much and how big a risk is this? Prashant Jain has done this exercise looking at it from 3 different prisms, and here is his take.
If you look at present valuations, they're about 15 to 25% higher than 10-15-year averages in terms of multiples. We think India's current multiples deserve to be higher than the past because our growth rates are likely to be somewhat higher. Our cost of capital has dipped sharply. If you look at the gap between US and Indian and US rates, the gap used to be between 4 to 6%. It is now down to about 3%. The forward premium of dollar is running quite low. So the cost of capital in India has moved lower, and the volatility of Indian equities has decisively moved lower as well. And this is driven by sustained healthy domestic flows. So I think in view of the sharply lower cost of capital, I think it is natural to expect higher multiples compared to the past. Now, whether that fair multiple is 15% premium or 30% is hard to guess. But given the 20-25% premium, I think we are directionally okay. I think compared to EMs, our expansion in premiums over EMs can largely be explained by this increase in India's multiple. So it is not worrisome because I just mentioned, it is quite easy to explain. Now, we did a rough DCF exercise and you looked at the trajectories of other large economies in the world. How did they behave over the next 20-30 years once their per capita income was around $2,500, where India is today? And based on that exercise, it concludes that we are about 10% overvalued. So net in conclusion, we think there is very limited room for multiples to re-rate. We think over time returns should be equal to the earnings growth rates, and which itself we think should be around 11-12% CAGR only, because India is now a lower inflation country and there is very little room for margins to increase in any sector.
Fair enough. So stocks are overvalued 10 to 15%. But where do we go from here? Since the pandemic, every single year the Nifty has climbed a new high. Could Nifty make a new high in the coming year too? And what kind of returns should one expect? Listen in.
The downside in Nifty appears to be limited to my mind, because Nifty has not outperformed economic growth. If you look at 10-20-year returns of Nifty, it is close to growth rates of economy in rupee terms. And there are large pockets of Nifty like banks which have underperformed, where valuations are reasonable. These valuations have reset to the current growth outlook. So I suspect that the downside in Nifty is not much. In fact, over time, I think Nifty should do well. It should deliver positive returns. And see, in Nifty, you are not seeing too much dilution. So you are seeing huge amount of dilution in other sectors. But banks are not diluting.
Correct.
The established banks, software is not diluting, consumer is not diluting, large pharma companies are not diluting, large auto companies are not diluting.
Right.
So I think the supply of stock is huge in outside of Nifty companies, which is quite logical also. But I think given the persistent healthy flows that mutual funds are experiencing, I think, and lack of supply, I think Nifty valuations returns should ultimately catch up with the broader indices.
If we are double digits, I'll be very happy. Market is ahead of reality today in terms of valuations. Happier if it consolidates, so I don't have to sell some of my darling companies because they get overpriced, and I can continue enjoying the compounding for a period of time.
Over the 30 years of my experience, this is one question which is kind of least relevant for me, that where is Nifty going? Because at the end of the day, I have learned one thing, that as long as I don't have a view that Nifty will correct by 30-40% or rise by 30-40%, right? I think even if Nifty remains range bound at a plus 2,000 points and minus 2,000 points, I don't think it impacts health of people like me who are bottom-up stock pickers. However, since you have asked this question, I would say over the next 6 months, it will be broadly maybe range bound, and I don't see a very, very big upside in Nifty, neither do I see a big downside. Unless you have some global accident, which obviously no one can assess or comment on, I would say, this is going to be a range bound market for this year.
The Nifty 50 gained about 27% over the past year, but the mid caps and small caps clearly stole the show with double the returns. Manish Chokani gives a top-down view of this market dynamic and how do you move forward.
Of the NSE 500, and let's say I'm just approximating to $5 trillion, there are 11 companies which are 25% of that. So $1.2 trillion odd dollars, and the average company is over $100 billion there.
Right.
So it's obviously that much harder to create compounding on that base. Like Reliance, I think ROI is now single digits.
Correct.
So to expect that stock to be delivering performance much ahead of its ROI for a long period of time is difficult unless the returns follow. you come to quartile 2, which is say the next 30 companies. So 30 companies will be an average of $1.2 trillion. So it gives you what, $40 odd billion is the number over there, where enough wealth has been created. Quartile 3 is about another 80 odd companies. And again, $1.2 trillion, so about 14 odd billion dollars there. But the tail, which is 370 companies,
Right.
that's the $3-4 billion market cap, 25,000 crores, which is now the definition of a small cap in India. That's where the whole action has centered around.
Correct.
And that's really where a lot of the excesses have also happened, because in this euphoric rise, they're chasing momentum of earnings now and forgetting that there's a price to pay for everything. And I always give this example that you can have the best company in the world, but if you pay the wrong price, you spend decades correcting for it. In the 90s, there was Hindustan Lever, which you will remember also.
Right.
Till 98, it was
Flat.
3,000.
Correct.
And then the next 12 years, it spent recovering that same price.
Correct.
The same thing, our favorite company, Infosys, where a lot of us made our fortunes, it peaked at a $45 billion market cap in March 2000.
Correct.
And it's today somewhere north of 90 billion. So it's doubled in dollar terms, which means it's say 4 times in rupee terms.
Right.
In that period, the index is up 14 times.
Correct.
So you can be in the best company and not make a return. Same way, the leaders of the 2000 to 2008 bull market, the Reliances and all of the world, as you're saying, did not participate till 2020.
Correct.
And then, of course, it went 4 times.
Right.
This bull market also, if you look back, were the laggards of the 2008 global financial crisis. So real estate, infrastructure, power, capital goods, they didn't do anything for the last decade. And then they've come roaring back in the last 4 years. By the same token, the leaders of the last bull market of 2000 to 2020, which was HDFC Bank, Kotak Bank, Bajaj Finance, Nestle, Page Industries, they've not delivered returns commensurate to what the market has done now. But this is a cycle which plays out.
Right.
And I would expect in this cycle, you will get a lot more money going back to the so-called perceived laggards. Like there were memes going around on ITC.
Yeah.
You remember? And then it just doubled and no one noticed it.
Correct.
People didn't want to touch Coal India because it was a sort of ESG-hated stock.
Correct.
And Coal India miraculously gives you return.
Right.
And I suspect the same thing is happening to banks because it happens to be $1 trillion market cap, roughly. And most of it is float. So it takes a lot of money power to pull those market caps up. But if you see conversely, while we say banks haven't done well, when I look at PSU banks and my smaller banks, they're done spectacularly.
Correct.
And the so-called corporate banks of the last era,
Yeah.
ICICI, SBI, Axis Bank, they've done well.
Correct.
So, and the story may just be starting for a lot of these now. So you play these ebbs and flows,
Right.
And that's really the only way to be placed in this market.
Now, one reason that created buoyancy in the mid and small cap space in the recent years to begin with was the huge surge in earnings. And this in part was contributed by the weaker unorganized players going out of business post GST. But now, some experts believe this trend is probably reversing and therefore a certain pocket of stocks will come under pressure. Listen in to Saurabh Mukherjee.
For reasons, again, I can't put my finger fully on it. There seems to be plenty of black money in India. And wherever I'm going, wherever I'm traveling, I'm seeing a plethora of unorganized sector brands. Unorganized in the sense I've never heard of them. They're not conventional brands that we associate with. FMCG, electricals, sanitary ware, building materials. And these unorganized brands are booming once again. And when we ask distributors or dealers, they are saying that cash is back big time, not just in real estate, but more generally in the country. Black money is back. And what that black money is doing is it's allowing these unorganized brands to flourish. So I don't fully understand why in the last year or so there's been such a sort of resurrection in the supply of black money. Black money liquidity seems to be abundantly available. Real estate activity in many parts of the country once again are being driven by black money. But the presence of black money means, Mahalakshmi, that brands which are operating now on a large scale, almost organized type scale, but they don't pay tax, they are flourishing once again. And in that regard, you're right. This is very much a reversal of the formalization trend that we had seen under NDA 2 up to, say, 2021.
One question which everyone wants to know is, should you be buying stocks that have corrected over the past few months? Several quarters, for example, defense, some power companies, some manufacturing companies have corrected significantly, 30-40% over the past few months. Have these seen their peak? Are they likely to correct more, or is it time to accumulate these stocks once again? Madhukela Vezin.
Very difficult to answer peak and bottom, honestly. But clearly momentum has corrected, and there is no doubt the valuations were very stressed. Now, whether they will settle here or they will settle 20% lower, 30% lower. And it's again difficult to generalize about the whole sector. Within that, there could be some opportunity also where the stocks may have corrected, earnings have not that corrected, and earnings look very good over the next 2 years. But in general, to say that you will make money, whatever you buy in railway, whatever you buy in defense, whatever you buy in PSU, you remember we became bullish on this sector very early on in 2021-22, whether there was a sector call to buy it. But I would say no, this is more a specific bottom specific company call than a sector call now.
Talking of economic headwinds, how does one really map the market? Which sectors or stocks are now facing maximum headwinds and which ones still have some tailwinds in their support? Madhukela Vezin again.
I would speak from a perspective of a stock market. Some of these businesses may continue to do well, but because they have a lot of stocks which have run up significantly, so I think possible headwinds could be in defense sector or railway or the overall overall infrastructure, which has also done very, very well in the last couple of years. So the stocks actually which have done really well in the last 3-4 years and are trading at some unreasonable valuation is what I would say you have to find headwind on. In the short term, I am being told a tremendous amount of work capacity is also coming in the steel sector. So that might also see some pricing pressure locally, So some of the companies wherein valuations are unreasonable, they belong to these kind of sectors. Even FMCG, for instance, in the short term, clearly valuations do not justify the kind of earning growth and the consumption slowdown which has happened. In the tailwind side, clearly financial services, select manufacturing, select stocks in pharmaceutical, and again bottom up. There are a lot of new category of industries and companies which are coming. A lot of very, very good quality businesses are getting listed in India, and you will get some really good opportunity if you are focused on it.
One absolutely discomforting trend in the stock market has been unabated selling by promoters over the past 2-3 years, both by Indian businessmen as well as foreign multinational companies. It might sound like a cliche as we keep asking this question again and again, but is this suggestive of markets peaking? Manish Chokani and Prashant Jain share their takes.
So if I look across the world from GE of America and Whirlpool to the UK where Vodafone and BAT have come and sold down, to Japan where Sumitomo has sold down, to even the Koreans Hyundai, now Samsung to follow, to Singapore where even Singtel has come and sold down.
Totally.
And even Indian promoters, Tata Sons has sold TCS, Vedanta, promoter has sold down his stake, and so many more.
Yeah.
So the fact is the demand-supply balance has come kind of close to each other. In the last 6 months alone, fresh capital for business raised has been about $15 billion. But promoter and PE selling has been $15 billion.
Correct.
So that money is not going to fresh capital creation. It may at best come back in the stock market.
Correct.
But it's not creating new capacity for you.
Yes.
So if this balance tilts, you can get a setback.
It's quite evident that the supply of IPOs is going up rapidly. If you look at the pace at which promoter stakes are coming down, not because they are selling, but because they are diluting, it is quite significant. For the first time in the history of Indian capital markets in last 1 year, we have seen where MNCs have sold down stakes in listed companies. And now we are going one step further that the Indian arms of these MNCs, the Indian businesses of these MNCs are getting listed in India because the valuations in India are much higher than what these parents traded outside. So I think Hyundai was the first of this such case, and we would expect a lot more companies to go public. So I think the supply of stock in India seems to be rising extremely rapidly. And now we are seeing a trend of even cash-rich companies that otherwise don't need capital, that even they are planning to raise large amounts of equity capital because the valuations in some pockets are extremely attractive from their perspective. So I feel this significant supply of stock, and I think this will keep on rising if these high valuations sustain. I think that will also lead to moderation of returns, moderation of valuations, at least in these pockets. And we have seen something similar even in the past. We saw a lot of fundraising in 92, in 99, in 2007. And this fundraising was concentrated in sectors that were very expensive. And ultimately, the valuations in those sectors moderated over time. So I would expect something similar to play out this time around as well.
One question that is perhaps less relevant for the performance of our markets, but still everyone would like to know is, will foreign investors take to India in a big way this year? Listening to Manish Chukani.
Number one is in your home market when you're making so much money by doing nothing.
You don't need to explore.
If in India you could just make money by buying Reliance, ICICI, HDFC Bank and Infosys, would you think I want to go and invest in Sri Lanka?
Correct.
In the context of the world, if US is $60 trillion market cap, we are at 4. You make more money on Nvidia in a week than you would do in the whole year in India. Number two, we were not really part of the global indices, and emerging markets as a category died. Because of the blow up of Russia and China. Russia even.
Russia also, correct.
It became uninvestable. So people don't really have India specific funds.
Correct.
So unless you come into global indices, like it happened with the bond indices, and we'll still be 3-4%. And at 3-4%, the spectacular outperformance is done. So it's not like the fund manager loses his job if he's not in India. But that money will come, and our share of world market cap has to go up. US cannot remain at 60-62%. So some of these corrections lie ahead of us.
And now coming to key risks for the coming year. Broadly, most experts seem to concur that largely the risks to markets come only from earnings slowdown and valuations, but there are a few global factors that need to be watched as well.
There are 5 risks which I have top of my mind. Number one is predominantly is this debt. It is just unserviceable. And I just want to again elaborate that if your debt is 300% of GDP, and if you're paying even 3% on it, that's what, 9%? And if you're growing at 4%, that means your debt is compounding at a rate which there's no way you can service. Plus, the developed world has unfunded pension liabilities, healthcare liabilities, and now increasing defense liabilities. If they're writing $500 billion checks to Ukraine, it doesn't come for free. Someone is going to pay for all this. So that debt event is imminent. Geopolitical strife, because the great powers are now again fighting to posture. And this US-China fight, I hope we stay out as the neutral party and let them figure out what they're doing. But this is a real problem for the world, and 2 camps have happened. Third is internal politics in most countries have become very starkly divided. And what that does to breakdowns of societies and economies, I don't think we've seen. We saw it remotely as the breakdown of Soviet Union. But we haven't seen this happening in the developed world. Like if you go to France, or you go to UK, or you go to US, they have fractured societies. So what does this mean for the world? What if you have an Arab Spring over there, or a Bangladesh type of thing in one of these countries? We don't know. So debt, geopolitics, internal politics, climate change, which we know if Bangalore can get flooded and you're thinking I'm going to compound and you can't even work from home, what happens to you? Stuff like that. And number 5 is the biggest imminent threat to India is tech. The disruption happening there. If the world's going to be AI enabled in the next 4 or 5 years, what it means for our whole IT space, our GCC space, what does biotech mean for our entire pharmaceutical space, what it means for our manufacturing base to get robotics and sensors and AI enabled stuff is transformational. So what India will look like 5 years from now, we should be thinking about today and making those investments. But I don't think we are on that path, but maybe not fast enough.
So one is geopolitical, clearly the tensions between US and China, and we don't know if Trump comes in, where they will head, that is a clear risk. Second, I would say the global, I don't know whether it will play out in the next 12 months or 24 months, the overall debt level in the world have risen to unsustainable levels, and at some point of time it will play out and it will be ugly. We are pushing the envelope every time, but whenever it plays out, it will be ugly. So I would say, and third, clearly the technological challenges. We don't know what the AI will do to the world, what the big data will do to the world, who will get impacted. While it looks like everyone will benefit, but we know if Apple came up, Kodak had to give away or Nokia has to give way, right? So these technological changes will have some profound impact on a lot of companies and sectors, specifically in the next 5 years. So you have to be alert. I am not saying technology is bad, but you have to be alert. You should not get caught unaware.
That's pretty much the prognosis for this year. The phase of easy money is clearly over and the pitch is only getting tougher. So how should investors deal with this kind of a market? In Prashant Jain's words, this is not a pitch investors should be hitting at the boundaries. They should instead be aiming to score singles. How do you do this? Listen in.
Reduce risk in the portfolios, focus on quality, strength, sustainability of the businesses, avoid businesses that are less sustainable, weaker, where growth is temporary, sustainability is low, and focus a lot more on valuations, because if you overpay and growth slows down or growth is below, even slightly below expectations, the markets can penalize these companies very heavily. And you are experiencing that in the consumer companies now. I mean, these are high quality companies, but growth is slightly weaker. So the penalty can be quite high. So this is what we mean, that reset your return expectations lower and manage risk, focus on quality and valuations of businesses, and don't endeavor to generate high returns, because I think that scope is not there in these markets.
In a market that is somewhat stretched across the board, which sectors should you prefer and how do you really guard yourself against losses? Madhusudan Khela and Saurabh Mukherjee share their thoughts.
Where I see opportunities, clearly one is in the pharma space, which has been one of my favorite sectors to invest into, specifically on the mid-size pharma, which has given very good return in the last 1.5, 2 years. I still feel there is money to be made there. And the second, I would say, broad financials. In the entire financial services sector, there will be some select private sector banks, capital market related companies, some companies which are service oriented in financial services, because this is one structural trend, Mahalakshmi, wherein we are seeing 4 crore demat holding become 17.5 crore, and this is not going to go away in a whiffy. This is a very sustainable trend. This is true recognition of equity as an asset class. So, and this formalization of financial services will benefit a lot of people. You have seen significant gains by some companies in this sector in the last 2-3 years. I would say this is one business wherein more than 100-120 companies are listed. So you will have a few really good investments coming your way in the next 2-3 years.
Highly likely that we see in 2025 the old-fashioned IT, pharma, FMCG troika coming to the party again big time. Pharma has already been doing well because China has banged down the prices of pharma raw materials. IT has only recently started a recovery, but I think we could see the IT recovery sustaining pretty powerfully into 25, especially if the Fed continues cutting. And I think FMCG could once again become a glamour sector if the government rolls out the red carpet for rural India.
And we asked Manish Chokani, how is he preparing to play the game this year in Samvat 2081? Here is what he has to say.
So as an investor, one is always like, I'm a for lack of a better term, we are farmers. We plant our seeds and we wait for the crop to grow. Some crops grow in this season, some crops grow in next season. So it's never that you harvest the whole crop in one stroke and go. And there's always things to do in this market because it's such a wide, exciting country with so many opportunities. When there's something overpriced, we typically tend to sell before they get very, very overpriced. And we typically tend to buy things which are borrowing a couple of years ahead of the market. So we are allowed to sit, and plus, I don't like paying short-term gains tax. So I'm happier if it doesn't move for a year and then it moves.
That's largely the big picture. Now listen to some of our expert takes on stocks that might be worth looking at from an investment perspective this year.
From a Samvat perspective, first is from the quick commerce, the space is Zomato. The core food delivery business has become stable, and growth is being witnessed in the new segments. The Blinkit, which offers a once-in-a-generation opportunity to participate in the disruption in the retail, grocery, e-commerce space. Hypersure business is stabilizing and improving, and Zomato has prioritized investments in the quick commerce, focusing on expanding Blinkit, entering into newer cities, enhancing its presence, diversifying into various categories like your electronics and other segments apart from the foods and staples business. So we have a buy rating on Zomato and a target price of 330 on that one. The second company from the mid-cap space again is from the EMS, which is Keynes Technologies. It is scaling up its business across segments. It recently entered into the smart metering business and set up a new factory in Hyderabad. So that is also growing. That is expected to grow fast. The company is setting up an semiconductor OSAT plant in Gujarat, which will come up over the next 2 years, which will drive the long-term growth. So I think Keynes is set to not only benefit from the increasing manufacturing of electronics, but also getting into the semiconductor business. So very strong growth, almost 60-65% growth in the next 2 years, and from there you will have the added growth of the semiconductors. So that company we like. We have a target price of 6,400 on Keynes.
So auto space has been in limelight for, I guess, for not so good reasons, but we are still very optimistic on Bajaj Auto despite street feel that it is quite expensive. I think the growth levers in Bajaj Auto are pretty high, or numbers are pretty high. And we believe that from current levels also Bajaj Auto looks pretty decent. Yes, valuations are aggressive, but we have revenue visibility and growth visibility, and one has to pay price for it.
And finally, now we come to the Pataka round, where we have qualified stocks as Patakas based on their performance last year, and we have quick takes on what is the outlook for them in the coming year.
Hello and welcome to Moneycontrol's Diwali celebration for Samvat 2081. As we bring in the new year, let's have a look at some of the stocks that have taken over the Dalal Street over the past year. With me, I have my colleagues Lavisha Darad and Zoya Springwala, and together, let's have a look at some of the blasts from the past. In this section, we will have a look at some of the few firecrackers, some that have taken investors by storm and some that have fizzled out, leaving investors wanting for more. So without further ado, let's get our first Pataka on the wall. So this is the Fulgari. These stocks have sparkled in trade not only because of their high trading volume, but also because they've seen significant investor interest. So Zoya and Lavisha, why don't you tell us as to why you've chosen Suzlon and Yes Bank as your top Fulgari picks?
So Suzlon shares have been crackling in trade over the past year, grabbing investors' attention following a host of order wins and its debt-free status. With heavy trading volumes and incredible buying interest, Suzlon has definitely remained a sparkler over the past year.
That's right. You know, after Suzlon, a favorite stock that will be coming in for today, and Fulgari as well, the meme stock of this year as well, that is your Yes Bank. Well, you know, the stock hasn't really performed well in the benchmark as well, declining about 4% so far this year as well. But however, it continues to be a heavy volume traded stock among market participants as well. Even in the recent September quarter, the private lender also posted an upbeat performance across all the metrics. Its net profit jumped about over twofold annually in Q2, and there was no visible sign of asset quality stress as well. Now, this comes at a time when most other private lenders have been facing worsening asset quality picture due to microfinance loans. So that is the Fulgari stock right in for you, Veer.
All right, thank you so much. And let's look at the second Pataka on the wall. So this is the ground wheel or the chakri. These stocks have firmly remained grounded, they're popular, but they haven't risen very much or far too low. So let's see what are the chakris of the past year.
So for you guys today, I have two major Nifty 50 contributors, Asian Paints and Kotak Mahindra Bank. Let's talk about the paints major first, Asian Paints. So it's seen a lot of up and down movement, but over the past year, it's trended quite close to the flat line. Stiff competition from competitors, high margin pressure, and extreme commodity volatility have all weighed on this once loved street darling and has caused it to remain more or less flat. So it's remained a chakri for us over the past Samvat. So looking towards our second chakri for the year, it's Kotak Mahindra Bank that has fallen about 10% since the start of the year. The downward trajectory kicked off when the Reserve Bank of India asked the bank to stop onboarding clients through its digital portal. Now this has led to investors leaving the stock. But however, over the past 3 years, shares of Kotak Mahindra Bank have remained flat. So let's hope that the new year brings in some new change for Kotak.
All right, those were some interesting insights. And now it's time for the third Pataka on the wall. This is the Anar. Anar are those stocks that have risen fairly quickly but have also seen an equally sharp downturn. So Zoya and Lavisha, tell us what are your Anar picks for this year?
The PSU basket, mainly railway and defense stocks, have given investors stellar returns in the recent years, with some names surging over 400%. Now the two sectors are seeing valuation concerns, which has led to investors being cautious, and they have been taking some profits off the table. Furthermore, the little to no mention of these sectors during the union budget has also left investors unimpressed by the possible growth prospects.
Okay, so yes, we have been talking about the Anars of this year. So I have two stocks in my pack, that is your Bajaj Auto and Tata Motors as well. Now, if you look at Bajaj Auto, the stock has done fairly well this year. It started the year on a positive note driven by healthy results as well as sales numbers as well. Now, the stock has delivered nearly 50% returns to investors. However, now considering the steep valuations of how much the stock has, given a sharp run up, much of the positive news has already been priced in. That's what experts have been pointing out as well. To add to it, the management has also painted a somber picture to Bajaj Auto's growth triggers. Recently, they came out saying that the festive sales have started on a muted note, while the industry is expected to show a growth of about 5 to 8% on-year sales growth. Actual figures still are closer to 1 to 2%, which is similar to yesterday's or last year's performance as well. So at a time when premium motorcycles are driving most of the industry's sales, Bajaj Auto's entry-level products have been languishing in trade as well. So we'll see whether or not the bear run for Bajaj Auto has just begun and how it is going to perform in the next year as well. But coming to another stock in focus, that we have your Tata Motors. Well, the stock started the year on a positive note, breaching past that 1,000 rupees mark for the first time ever as well. But now the stock has been trading around that 800 rupees odd levels as well, because there are certain concerns about margin pressures about its luxury arm Jaguar Land Rover, which has come into limelight. So the point is that the demand for premium models that have been waning and the orders have started to fall below the pre-COVID levels as well. So we will be seeing whether this bear run for Tata Motors also has begun. So these are the two Anars right in for you, Veer.
All right, those were some very interesting insights. Now it's time for the fourth Pataka. The fourth Pataka is the LXMI Bomb. These are wealth creators that have given multifold returns over the past year, and now it's time for us to dive straight into these solid money-making stocks.
So the LXMI Bomb that I have for both of you today is BSE. BSE has surged a massive 120% over the past year, more than doubling investors' wealth. It's India's only listed stock exchange, and investors have been really upbeat about this stock, largely driven by increased retail participation, the possible listing of NSE, and SEBI's F&O norms, which are expected to kick in anytime. However, some brokerages have suggested caution going ahead. So let's see if this LXMI Bomb can give us the same kind of returns next year.
Zoya, you mentioned about LXMI Bomb and BSE as one of the stock as well. So we will be talking about a pure power play in my mind as well. That is a CESE, the flagship company of RP Sanjeev Goenka Group. Now the stock has surged about 34% so far this year, and it manages power generation projects in India as well. And given that we have been seeing a healthy power demand in India as well, it is only possible that the stock's growth journey is positive going ahead as well. Now, another stock that I have in my bag as well, that is your LXMI Bomb, which is your Nippon Life. Now, the stock has soared over 50% so far this year, as equity flows into the markets always remain healthy. Even the September quarter update reflected some optimism about Nippon Life, wherein SIP flows, that rose about 20% on a sequential basis. And equity OMS, that has also risen about 70% sequentially. So let's see if it sustains the momentum for the coming days as well. Nippon Life, that's the LXMI Bomb right in for you, Veer.
Now it's time for the fifth Pataka on the wall. Now that is the 1000 Ladi. These stocks have been loud and proud and have given consistent returns with a solid uptrend. And if the sentiment persists, we won't be surprised if these stocks continue to do well in the coming years too.
Consistently consistent, I have 2000 Ladi bombs for you. The first, public sector bank SBI, and second, private sector bank ICICI Bank. Now these two have blue chip large cap banking majors that investors would have not regretted putting their money into. The BFSI space has seen a lot of turbulence over the past year, as we all know, but investors are overwhelmingly positive on SBI and ICICI Bank due to their strong growth, their very stable asset quality, and their effective cost management.
You know, Zoya is joining the pool of this consistent wealth creators. I have NTPC in my bag. Now, so far this year, this power play stock that has surged about 30% so far this year. Even last year, the stock gave tremendous performance, surging about 80% in the last year. And prior to that, it was also up about 33%. So a play on renewable energy, strong capex program, and healthy power demand, all of them bode well for the stock as well, and has remained investors' favorite as well. So moreover, their ambitious IPO plan of NTPC Green Energy, now that is also expected to kick in and expected to create and unlock value for NTPC shareholders. So we'll see how this NTPC stock performs in the coming days as well. So we write in for you. We have 1000 Ladi, and that is your NTPC.
And the next Pataka we have is the 10,000 Ladi. These have been consistent outperformers, high quality stocks that have really wowed investors. So let's see what Zoya and Lavisha have as their 10,000 Ladi stocks.
So the next two stocks that I have to discuss are urban consumption-led plays, Trent and Zomato. These are stocks that have kept investors in a festive mood through the past Samvat. Talking about the Tata Group player, it has skyrocketed a whopping 200%, more than tripling investors' money. It has also made its spot into the coveted Nifty 50. As value retail emerges as the theme driving Trend's growth, the demand for Zudio's tops and those best side kurtis isn't going anywhere, according to analysts. Therefore, despite the massive run-up, some brokerages suggest that Trend actually has further upside from current levels, even after its 225% run-up. Let's move on to my favorite thing in the world, which is food. Restaurant aggregator Zomato has seen a 100% run over the past year as analysts change their mind on its quick commerce play, Blinkit. With 10-minute deliveries quickly becoming the norm, global brokerages have rushed to upgrade their target prices on this new age tech stock.
Well, you know, it's the Diwali season, and how can we miss not talking about gold? So the glittering metal on the MCX gold, that has surged over 20% so far this year as investors have taken refuge in the safe haven asset during the market turmoils. Now, be it the escalating tensions in the Middle East or the battle to tame inflation or even responding to central banks' interest rate cuts, gold continues to be one of the popular bet among Indian investors as well. So given that the gold's record rise from time to time we have seen, let's see how this precious metal and which level this precious metal rises to as well. Now, given that we have seen the sharp run-up in gold prices as well, so the gold-related stocks also cannot be ignored. Now, gold-related stocks such as Senco Gold and Kalyan Jewelers, both these stocks have given decent and exactly staggering returns to investors, surging about 88% so far this year. So yes, gold and gold-related stocks, Veer, that is for you, 10,000 Ladi. Gold stocks for you.
All right, thanks Zoya and Lavisha. Those were some very interesting names. And the next stock we have is the Suly Bomb. These are those stocks that have grabbed all the headlines and taken over all our conversations. However, mind you, that is not an indication of their performance at all. So let's see what these names are.
So Veer, my two Suly bombs for the year actually have to deal with the primary markets. The primary markets have stolen the headlines over the past year, with most of the chatter dealing with two public issues. These are Hyundai Motor and Ola Electric, are Suly bombs for the past year. As the largest ever IPO in India, Hyundai Motor had got everyone's attention. With discussions across forums and platforms, discussions spanning countries, people had a lot to say about this Korean automaker's listing. Much like Hyundai, Ola Electric too also swept the headlines as the pure-play EV two-wheeler company finally listed on the bourses. From excitement to caution, investors have discussed and dissected every little aspect of these firms.
We cannot miss to mention the SME IPOs. Well, SME IPOs, they have been under the SEBI's radar for quite some time for its rapid subscription figures, wherein investors have poured loads of money in most of these unproven companies. Now, a recent case has been Resourceful Automobile that attracted bids of over 5,000 crore rupees, and other SME street wonders also included like the likes of Hoke Foods that attracted bids of over 11,000 crore rupees as well. So yes, that is in for you.
All right, those were some very interesting names again. And the next Pataka we have on the wall is the Rocket. Rockets are fast and agile up movers that have given superb returns in a very short span of time. So Lavisha and Zoya, what are the rockets of the past year?
So Veer, for me, without a doubt, EMS stocks will be my rocket of the past year. These stocks, especially the three flagged here, have seen significantly sharp up moves on favourable government policies and the Make in India thrust. These have boosted the outlook for these names. However, it remains to be seen if these guys can be rockets in the next year as well. Because after having surged over 100% each, some analysts suggest that the valuations might be a little stretched as all the positivity might be baked into the stock price.
All right, so that is EMS stock for you, Zoya. But I have another one, that is your Bajaj Housing Finance. Now, it is a recent debut on the Dalal Street. It listed at 114% premium over its issue price. And the street is hoping that it could be the next HDFC in line. So the company has been focusing towards individual housing loans as well. And given that the realty market is also looking strong with multiple project launches in line, it paves a strong growth and a positive trigger for Bajaj Housing Finance as well. So that is the rocket stock for you, Bajaj Housing Finance. Veer and Zoya, right to you.
All right, now it's time for the next Pataka on the wall. Now that is the gun tape stock. These are stocks that have seen step-by-step movements. Some have given us high dividend payouts and just largely have seen single focused upward runs. So what are the gun tape stocks for the season gone by?
Well, for me, my gun tape stocks got to be Coal India. Breaking out of a long slump, Coal India's shares have risen about 40% from Samvat to Samvat. This dividend-given PSU has seen its fair share of critique, but has seen sharp step-by-step movement with surges. However, the fossil fuel player is turning its company around with a chunk of its planned capex to look at non-coal oriented growth such as thermal and solar power. So what about you, Lavisha? What are your gun tape stocks?
Well, Zoya, after Coal India, it is the OMC stocks. Now, be it HPCL or BPCL, both these stocks have surged over 30% each so far this year. Now, the crude oil prices, they have seen a bit of a cool off. However, with rising Middle East tensions, crude oil prices have been volatile, keeping their margins and cost pressures in check as well. So, but we'll be watching out how the crude price movements will be going out because we have been having the state elections in Maharashtra and Jharkhand later this year as well, and we have Delhi elections later in the next year as well. So yes, OMC stocks are right in for you, Veer.
All right, thanks Zoya and Lavisha. And the next stock on the wall is the first Pataka. We were all expecting an explosion, weren't we? So these are those stocks that had so much potential but did not rise to the occasion and satisfy the hype. So Zoya and Lavisha, tell us about your first Patakas of that year.
So Veer, for me, the FMCG pack has to be my first Pataka over the past year, with biggies such as Nestle India seeing flat growth. This Maggi maker has been stressed with commodity inflation weighing heavy, increased competition and also stressed margins. The FMCG in general hasn't seen any revival with rural demand, aberrant weather patterns and volatile food inflation. The pictures on the cards isn't too pretty. So what about you, Lavisha?
Well, since you talked about Nestle India, Zoya, I have a rural consumer staples play, that is your Dabur India. That is to be my first Pataka for this year. It has followed the FMCG pack and has been languishing in trade. With only small green shoots which has been visible in the rural sector, investors are now left waiting for an uptick before buying into the Dabur's growth story once again. So there's the Dabur India and Nestle. Those are the first Patakas for this year. Veer, let's see for what is the next.
All right. Thank you, Lavisha and Zoya. And now it's time for our last Pataka, and let's see what it is. So this is the misfired rocket. These are those stocks that we had really, really high hopes from, but instead of going to the moon, they've all sunk way below. So what are those misfired rockets of the last year?
Well, if we're talking about misfired rockets, I'm going to have to talk about Zee Entertainment. The street was expecting so much from this media and entertainment player, especially following the deal with Sony being announced. But unfortunately, we've seen how the narrative for this stock has played out. Some brokerages suggest that their bearishness on Zee will only change if there is a new partner or buyer for this company. However, who wants to save this damsel in distress?
Well, we'll be seeing who is going to save that damsel in distress for Zee, Zoya. But another stock, misfired rocket, is the microfinance sector. Now, over the past year, it has seen significant stress, with challenges likely to persist as well, given that we have been seeing stress in the asset quality in this year as well. So now several microfinance institutions that have been flagging off operational challenges, especially due to elections and heat waves. The stress in the sector is likely to bring down the total OM and impact profitability as well. Additionally, with the RBI cracking the whip on this sector, let's wait and watch out what this happens to the microfinance as well. So those are the misfired rockets for you, Veer.
So this pretty much brings us to the end of the Muhurat trading session. Thank you so much for watching Money Control. Wish you all a very happy Diwali once again and a very profitable new year. Thank you.